Your career feels stuck. You're waiting for that perfect opportunity to come along. But here is the truth. Opportunity isn't something you wait for. It's something you build. Welcome to NISM e-learning, where your financial career takes flight. We are NISM's online learning platform. Whether you are starting fresh, switching careers, or sharpening your edge, we are here for you. Quality education, affordable pricing, zero barriers. No matter where you are or when you learn. Industry designed courses from securities market veterans with decades of real-world expertise. From foundational financial literacy to specialized expertise, equities, mutual funds, derivatives, compliance, risk, wealth management, and beyond. NISM e-learning course covers securities markets areas comprehensively. This includes topics related to mutual funds, financial planning, SME listing and compliance, forensic investigation, anti-money laundering, and more. Every course is built with leading knowledge partners and academic experts, thoroughly vetted and constantly updated. Your journey starts now. Visit online.nism.ac.in today. Learn at your pace. Learn on your time. NISM e-learning. Build your future.
And good evening to everyone. And before I forget, my best wishes for a very happy new year to all of you. Thank you for registering and participating in today's webinar. I hope it's going to be very useful for you and makes you much more smarter, more aware, and more empowered investors in the year 2026. So without wasting much time, I will start. We have about 45 minutes for the presentation, and we will take your questions for about 15 minutes post that. Okay, I hope this is visible to everyone.
Yes, sir, it's visible.
Okay, thank you, Sahil. So investing mantras to help you in 2026. Honest confession before I go into the actual mantras. The mantras for 2026 are very similar to the mantras for 2025. No change. To be even more honest, the mantras for 2025 were the same as it was for 2015. Okay, which indeed was, to be brutally honest, was the same as the mantra for 2005. So if I was to make this presentation 2 decades back, if Rasmeet ji gave me the floor to make such a presentation 20 years back, in all probability, I would have the same slide stack. Okay, so the mantras don't change. So you have a Gayatri mantra, which has been eternal for more than 3 millennia. Okay, so similar to that, you have investment mantras which have not changed for decades. So the mantra number 1 is save adequately. Okay, you must remember that savings are the raw material for building investments. Now, before I explain this, let me, request Sahil to put up the first poll of the day. I would like to know your feedback on this. Okay, can we have the poll, Sahil, the first poll?
Yeah, poll is
Yes.
live, sir.
Thank you. You will have to just give me your best opinion on this. How much of your income should you ideally save every month? So I'm asking it as a percentage. So I would request all the participants to fill what they think is right. Is it 10%, 20%, 30%, or 5% of your income? So by income, I mean post-tax income or take-home income. How much of that should you ideally save every month? So Sahil, when would you get to know the results of the poll?
Sir, right now only. I'm
Okay.
ending the poll now and sharing results with all.
Okay,
Yeah,
perfect.
it's visible now.
Okay, 50% of you say 20%, 32% say 30%. So if you take an average of it, 25%, I think 25% is a very, very good post-tax savings rate. 25% is ideal to, convert the raw material into investment capital. Excellent. So I think most of you are, started off very well. You have a good idea of how much you need to save. See, the traditional formula for savings is income minus expenses. So that's the formula that all of you used in the poll. Suppose you get an income of, say, 1 lakh. You have decided that 20,000 needs to be saved every month. So income minus expenses equals savings. So if your expenses itself is equal to income, say 50,000 minus 50,000, you have absolutely no savings. Okay, remember, like I said, savings are the raw material to build up. So savings capital is a raw material to build up investment capital. So what you need to do is something in financial terms called budgeting. Okay, so you need to budget your expenses. So like all of you, like majority of you said, 20% needs to be saved. So even this example assumes that, 20% is the bare minimum to be saved. So 50,000 minus 40,000 by cutting down liabilities, by cutting down expenses, by deferring gratification, whatever method, okay. So the family tightens the belt, okay, doesn't open the wallet, doesn't charge the credit card, and saves 10,000 rupees every month. See, in the US, after the global financial crisis in 2008, when they found that they were not saving enough, many personal financial experts advocated changing the formula. So instead of income minus expenses equals savings, what they did was income minus savings should be equal to expenses. Okay. So what needs to be done in this case is, in the first of every month itself, you need to transfer some of your income in as savings. Okay. Maybe on the first of the month itself, you should put aside some money into a systematic investment plan, or put some money into a recurring deposit, or put some money into a public provident fund. Okay, you can, now all of this is tech enabled, you can give standing instructions. So all of this promotes healthy and disciplined savings. So if you're having income of 1 lakh a month, if you can put a SIP or a PPF or a RD for 10,000 or 5,000 and 5,000 or 10,000 and 10,000, so 20,000 goes straight away into savings, and you are left with only 80,000 rupees to spend as expenses. So this, in investment terminology, this is called pay yourself first. So pay yourself first means the moment you get your check, you pay yourself 20% of that, okay, which goes into long-term investment planning. That's the idea behind it. So 50,000 minus 10,000, so 10,000. So if you're putting 5,000 into PPF, if you're putting 5,000 into an SIP, then 10,000 is committed and you have only 40,000 to spend. So this in a way, directs you to responsible investing. And this is the right age to start, okay? Like Warren Buffett once said, he started investing when he was 11 years old, and he said he was too late. Okay, so obviously the child may not know the right avenues to invest or the correct pathways to take, but the parents are there to guide them. So, and inculcate this responsible investing habit as soon as possible. Second mantra for 2026, please diversify. Correct. I'm sure all of you know the meaning of diversification. If you are in many, India's booming now, and real estate has always been, an investment of choice for many investors, be it in tier 1 India, tier 2 India, tier 3 India, rich investor, middle class investor, all of them have this notion that a real estate investment is a foolproof, fail-proof investment. Real estate indeed may be a good investment for many an investor. Okay, either a plot of land or an apartment, a second apartment, building a house, etc. But if you're going to put all your money into that, it is not diversification, it is concentration. Okay, so you must, desist from putting all your money into just one single asset class. You should explore all the asset classes. Okay, like I've put on the figure before you, in the slide before you, real estate, definitely you must invest. Okay, along with it, some amount of money in precious metals, some amount of money in fixed income. Okay, it could be a bank deposit, company deposit, some amount of money in, say, equities and mutual funds, some amount of money in small savings like public provident fund. So with this, you get a diversified portfolio, correct? So in a diversified portfolio, you don't work to increase your returns. In a diversified portfolio, you work to decrease your risk. Diversification means your risk comes down, okay? Doesn't mean that your returns will go up, correct? Concentration means your risks increase. What if something were to happen to that one single asset class that you are having? Okay, we will look at this definition of risk also in a few slides down the line. See, every single investment needs to be judged through the prism of three things: safety, liquidity, and returns. Okay, safety means safety of capital. Primarily, it means safety of capital. So when you put your money in savings bank deposits, when you put your money into a liquid fund, the capital is safe. So many financial advisors will tell you to invest 6 months to 12 months of your living expenses in something that is absolutely safe. That is called contingency or emergency planning. Okay, so keep it in a savings bank deposit, liquid fund, okay, or a short-term income fund. So these are safe. They are very, they will not compromise on your safety of your capital, which is very important. Second is liquidity. How liquid is my asset? Usually, financial assets are extremely liquid. Physical assets are not so liquid. Okay, physical assets would be real estate, apartments, gold coins, gold jewelry. All these are physical assets. Financial assets are equities, shares and stocks, bank deposit, mutual funds, gold ETFs, okay, sovereign gold bonds. These are financial assets. Financial assets are liquid. What is liquidity? The ability to, devolve or redeem that asset and get your money at the fastest possible time. You don't have that with physical assets. And third is returns. Returns is, which asset class is giving me the highest returns. Okay. So for example, equity mutual funds or stocks and shares or select real estate will give you the better returns. Okay. At times, equity will give you the highest return. At times, gold will give you the highest return. At times, real estate will give you the highest return. At times, one particular stock will completely beat all the other stocks. So returns are dependent on the asset you invest in. But there is a give and take in each of this. Okay, when you invest in some potentially high yielding return asset, it might be very volatile. Okay, it might give you returns in the long run. Correct? It might not have liquidity in the interim. Whereas an extremely liquid asset might give you safety, but may not give you returns. So you will have to figure out, which asset class gives you safety or how much of your money should be in very safe assets. Please remember, very safe assets tend to give you much lower returns than volatile assets, which can give you wealth creating returns. So when you speak to an investment advisor or when you read up more about investing, you will know this difference between safety, liquidity, and returns. And all three are very important. Third, very, very important mantra for all of you is be very, very disciplined, okay, as an investor. Like this very, very famous quote of Warren Buffett, the legendary investor, we don't have to be smarter than the rest. We have to be more disciplined than the rest. That's what discipline is. So in investing, intelligence is not as important, or IQ is not as important as EQ, your emotional ability to ride cycles in the market, okay? Or your emotional ability not to get carried away by market ups and downs, right? If you're going to be a long-term investor in an asset class like equity, for example, it might take 3 years, it might take 5 years, it might take 1 month, it might take 1 decade for it to give you the desired rate of return. Okay? So you will have to continue your SIPs, right? Because SIPs work best in a volatile market. SIPs work best in a market that goes up and down. Because all of you know in an SIP, in a systematic investment plan, you get more units when markets are down and you get less units when markets are up. So it is a very smart way to acquire, okay, ownership of risky assets like equities and other such assets. So in this journey of creating wealth over the long run, you should stay invested and let the power of compounding work to your advantage. That's where discipline comes in. So like Mr. Buffett says, you don't have to be smarter. The smartest thing you can do is to remain invested, to be a disciplined investor, to continue saving 20%, to continue delaying gratification, to continue, living within your means, to continue, shying away from very, very greedy gambling type of instincts. So that is what discipline means. So an SIP, for example, compounding in an SIP, compounding even in a fixed income asset like PPF is done gradually over a period of time. Even a PPF makes you, can enable you to create good wealth if you are there for 15 months, for 15 years, beg your pardon, if you're there for 15 years and contribute unfailingly on the 1st of April of every year. So then you get the money to compound within that year and across years also. So discipline is extremely important in the quest for wealth. So along with discipline, you also have to be patient. Okay. There's a similar trait: be disciplined, be patient. Like another famous quotation of Mr. Buffett, the stock market is a device for transferring money from the impatient to the patient. Okay. So typically, just to stereotype investors, an impatient investor is one who will sell when the market is low. But when he's selling when the market is low, that sale has to be bought by someone else, correct? Now that is going to be bought by the patient investor who knows ultimately the cycles will change. A cycle, just to bring you all up to date, a cycle can mean anything. It can be an interest rate cycle, it can be a commodity cycle, it can be a currency cycle, it can be a political cycle, whatever. Okay, when the cycles change, the markets also reflect the change. So in a stock market, right, you have to be patient. And if you, best returns may be around the corner, it will never announce itself. Okay. I have zero idea of how the market is going to perform in January 2026 or in December 2026 or in January 2028 or December 2028. We have no idea. But all I have an idea is I have to remain invested from January 2026 through January 2027. If I need the money in January 2030, my best chance is to remain invested and let the beauty of compound interest work in my favor. Okay. Between January 2026 and January 2030, the market can go through, 2-3 avatars. I have no control over it. I have no predictive ability over it. The only control is the control to stay invested. Similarly, Mr. Buffett's other gem is this. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Now, with this, Mr. Buffett, lays down the gauntlet for investors. Do you have the ability to stay invested for 10 years? Really good returns come in stocks or equity mutual funds if you can be here for this period. If you can have an SIP for 10 years, then you would be, going through multiple cycles in the economy. There would be, interest rate expansion, contraction. There would be favorable times of, FI inflow, FI outflows. There would be, political crisis, now and then. And all of them will, get reflected in stock prices and stock indices. The smart thing to do is to stay invested and take part in that. That's it. That's what Mr. Buffett is, requesting you to do. Just to show you with an example of the market, I've taken the example of the BSE 500 TRI, Total Return Index. So this is not stock specific. This is not fund specific or scheme specific. I've just taken a very, very broad market index, the BSE 500. So this has got large caps, it's got mid caps, it's got small caps, it has got mega caps. Okay, it's got everything. So if you have invested in the BSE 500 Total Return Index, over the last 1 year, your return is 2.95%. Okay. Now, looking at 2.95%, if you redeem, I don't know, but you may be foregoing returns in the 4, 5, 6, 10 years ahead. But if you look at the same, I'm just going by historical example, but if you look at the same BSE 500 TRI, it has given 15.28% compounded over the last 10 years. Now, just to give you an idea, 15.28% is something like your money doubling every 4.5 years, okay, or 4 years, 8 months. Imagine your money doubles in 4.5 to 4 years, 8 months. Your money is doubling every 4 years, 8 months. That's the sort of wealth creating ability. If you had invested in a bank deposit or some other thing that was giving you 7%, your money doubles once in 10 years. But in an investment like this, your money is doubling once in 5 years, once in 4 years. Again, this is past track record, may or may not be replicated in the future. That was mantra number 3. Before we get into mantra number 4, may I request Sahil to put the next poll? Sahil, can I request you to put the next poll, please?
Yes, sir. Yes, sir.
Yeah, poll is live, sir.
Oh, thank you. Thank you very much. Which of this is a physical asset? A, stocks and shares. B, bank deposits. C, gold ETF. ETF is exchange traded fund. And D, gold coin. One amongst these 4 is a physical asset. Which of these 4?
Sir, can I share results?
Yes, you can.
Yeah.
Okay, I'm not able to see the results, sorry.
No problem, sir. I will tell you that 4% of the participants have chosen A option, that is stocks and shares.
Okay.
2% of the participants have chosen B option, which is bank deposit, and 0% have chosen C option, that is gold ETF, and D option is chosen by 94% of participants, which is gold coin.
Perfect. I think excellent. All of you got the absolutely right answer. That was indeed the only physical asset in the amongst the 4 assets that were mentioned in the poll. Excellent. So all of you have been listening to me carefully. Thank you. So understanding risk is also very, very important. See, earlier in the program, I had shown you, various asset classes that you can invest in. Now, every single asset class has a risk, but the risk is not the same. They have a particular type of risk. So let me tell you well in advance what are the various risks. Okay, you can put in the chat box what is the risk with each of these asset classes. So the various risks are, there's a risk of capital, there is a risk of volatility, there is a risk interest rate risk, there is a liquidity risk, there is a credit risk, okay? There is a regulation risk. So these are various, there is a purchasing power, inflation risk. So these are the various types of risk, that each asset class is bound by. So when you invest in the stock market, when you invest in equities or equity mutual funds, what is the risk you're looking at? You can put your answer in the chat box. I would be able to view the chat box. What do you think is the risk in investing in the stock market or in equity mutual funds?
So you can see in Q&A section.
Okay, I can see. I will see. Okay, please put it in the Q&A. Thank you. Yes, I think absolutely. I think all of you got it. Wonderful, wonderful. I think all of you got. This is a clean sweep. All of you understand if you invest in the stock market or in equity mutual funds, you have volatility risk or capital risk. Okay, so that's the risk when you invest in equities. Absolutely right. What could be the risk when you invest in public provident fund? Something, a small savings like a public provident fund. What could be the risk? Okay, I will accept 3 answers were right. Regulation risk, inflation risk, and liquidity risk. You're all right. In some format, these are the risks. Okay, inflation, if inflation goes up, more than the 7% plus that the investment gives, then you have inflation risk. In public provident fund, the investment is locked in for 15 years, but there is a provision, of course, that you could liquidate it somewhere in between with some terms and conditions, or you could take a loan against it. And there is also regulation risk, all of you had told. Today, public provident fund is exempt from tax. What if the regulations change? What if regulations bring down the interest rate on a prospective basis? So these are regulation risks. You can't call it interest rate. Some of you have written interest rate risk. Interest rate risk primarily governs fixed income securities which are marked to market. Okay, I don't want to make it technical, but it is for dated fixed income securities whose values go down when interest rate goes up. Interest rate risk in that way does not affect public provident fund or Sukanya Samriddhi scheme. It doesn't. It is meant for traded and dated fixed income securities, which I have not put here. So if you have got money in a debt mutual fund, interest rate risk will affect it. What could be the risk with buying gold jewelry? What could be the risk in buying gold jewelry? Okay, great. Thanks again for the response. Many of you have written theft and it can get stolen. Let me tell you that may not be too much of a risk because if you look at larger numbers, maybe 1 in 100, 1 in 200, 1 in 300 cases, the gold jewelry is stolen. Okay, largely it remains put in a locker. It is kept under safeguards. So that is certainly not a risk. It is a risk because it gets noticed, it gets amplified. No other reason. But some of you have given the right answer. There is a liquidity risk. See, gold jewelry, even though technically a very liquid asset, you can go to a jeweler and sell it. But emotionally, most people do not sell gold jewelry. It is a legacy asset. It is meant to be accumulated and given to the next generation, kept forever, kept for adornment. So liquidity risk is right in that way. You will suppose you need money for a heart operation. You are unlikely to go and sell your gold bangles to fund your heart operation. Or if you want to give 3 lakhs for your child's education, you're unlikely to go and sell a gold necklace that you had bought for the child. Very unlikely. So practically, I think all of you are right in that sense. And of course, some interesting answers. Making charge and all that. Yes, very, very true. That's why it's better to buy a gold coin than buy gold jewelry. You save on making charges, wastage, etc. What could be the risk in a fixed deposit? Okay, great. I think all of you got it right. In a fixed deposit, primarily it is inflation risk. Could be even liquidity risk if the bank does not allow you to break the fixed deposit or puts a penalty on breaking the fixed deposit. But no, there is no interest rate risk in this in a fixed deposit, there could be something called a reinvestment risk. Reinvestment risk is basically this. When you invested in a fixed deposit, it was giving you 10%. Then interest rates came down. And when the fixed deposit finally matures, interest rate could be 7%. So you are going to reinvest it at 7%, not at 10%. That is called reinvestment risk. I would suggest really, because many of you are showing interest, okay, you do read more from either the mutual fund Sahi Hai portal or the NISM portals about both interest rate risk and reinvestment risk. What could be the risk in having a house like this? It looks like a good house. What could be the risk? If you put all your money into a house like this, what could be the risk? True, many of you are giving the right answer. All of you have given the right answer. Absolutely right. Absolutely. Liquidity risk is the main risk in such an asset. For example, if you want 10 lakhs, you can't sell that nice looking balcony in front and take 10 lakhs. Okay. So you have that inability to liquidate part of it, that, and raise money. You can do it with new instruments that are coming, like real estate investment trust and, real estate bonds or fixed income instruments, which mutual funds also invest through. Okay, so mutual funds, of course, invest in all of these. So I think all of you got the gist perfectly right. Mantra number 5: have a plan. However basic, a simple plan is perfect. Okay, please have a very basic, simple but logical plan. Okay, by simple, I don't mean, it should be a very illogical plan. It has to be logical. A simple plan is, I will save 25%. On the first of a month, I will put, out of that 25% which I've saved, I will put 50% here. I will put 50% there. I will keep aside some money for emergency purposes. That is a simple but workable plan. So you must have a very basic financial plan, very important. If you don't have a basic financial plan, you will be confused like this, okay? You will get a bonus, you will not know what to do. You might be getting, some amount of inheritance, you will not know what to do, okay? One of the spouses may leave work or switch work or start own business, you might not know what to do. There may be an emergency, you might not know what to do. So have a workable basic plan. That's more than enough. At least it gets you started. I mean, for a vehicle to move, you at least need to get it into first gear. First gear is the most important gear because it gets the vehicle to move. It gives the power to get all the four wheels off, to a start. So, and then you can automatically, it will go to second gear, third gear, fourth gear, whatever. But you need to know, okay, apart from driving the car, you also need to know the route it needs to take. Very, very important. So have a basic plan and have a goal-based approach. Very, very important. Okay. Spend some time, okay, in trying to determine goal values of your investment. Okay. Having an investment goal value is invaluable. Otherwise, you will be taking shots in the dark. So most upper middle, affluent or middle class Indians need to plan for, very high, very expensive higher education for children, okay? Or, above average wedding expenses for children, or your own wedding expenses. I mean, if you are going to get married 3, 4, 5 years down the line, all of these cost a lot of money. Aspirations have changed. It's a competitive world out there. So you need to have a proper goal value. So if you're going to plan, graduate, postgraduate education overseas, you need to determine how much it will cost 5 years down the line, 10 years down the line. It may be 500 million, it may be 1 crore. I need to buy a house after 10 years. It could be 500 million, it could be 1 crore, it could be 5 crores. I have no idea. But you need to have a good sense of how much your goal value would be after factoring inflation. Now, those were the 5 very, very important mantras that I had wanted to share with all of you. But I'll end with two bonus mantras. One, develop a consistent investment worldview. Okay. Develop a consistent investment worldview. What this means is that you need to have a certain belief system that will make you a responsible or a aware investor or a successful investor. Now, what do I mean by consistent investment worldview? You need to know the right risk behind every asset class. You need to know the definition or the difference between investment and speculation. Very, very important. Okay. If you are buying a stock because you are acting on a rumor or a tip or some influencer has suggested it and you're getting out in, say, 1 week, 2 weeks, 1 year, it is not investment, it is speculation. Investment is when you have done research, you know the route map, you know what the risks are, and then you put your money. That is an investment. Okay. If you don't know all of this, it is mere speculation. You are investing with hope and nothing else. Okay. So a consistent investment worldview means you need to know what is the real meaning of, say, long term. For some people, long term could be 6 months. For some people, long term could be 2 years. But in my opinion, if you're an equity investor and you want equities to give you money over the long run, you need to have a generational long-term view or minimum 10 years long-term view. Ideal would be generation. Okay, that's why earlier in the program, I put a slide of a child who started investing. Because when the child reaches adulthood, she would have given, 10 to 15 years for the investments her parents have made for her to actually compound. Now, that is a consistent investment worldview. You should know the difference between the various asset classes. You should know which asset classes are good for returns, which asset classes are good for liquidity. Okay, that is extremely, extremely important. So that's why you need to, and be consistent with it. You cannot be having, a dangerously wavering mind on this. Okay. Suddenly you have a fancy for IPOs. Even when you invest in an IPO, have you done research on that IPO? Okay. Just merely investing in an IPO hoping for listing gains is not investment. It is speculation. If you have done proper research, you have got, you know the prospects of that company. Okay, you know where the terrain that you're entering, then it becomes an investment. Otherwise, it is speculation. So, and you need to know what is the right time horizon required. You need to know the risks behind every investment. Okay, and you need to have the good idea of diversification. You need to appreciate the benefits of diversification. If you get carried away by concentrated assets, let me tell you straight away, a concentrated portfolio, while being extremely risky, can at times give you the greatest return. So for example, if you know someone who's an employee of, say, Apple, that company Apple in the USA, or, Amazon in USA, and they have got, ESOPs in that company, have been working in that company for 10 years, definitely they would be the most affluent investor. But that's a very, very concentrated investment. What if, instead of that one company, they were working in some other company that collapsed, or, or the cycle claimed it, whatever. So a concentrated investment may look very tempting to an investor, but always know the benefits of diversification. Like I said, diversification might, the main reason for diversification is to reduce risk, okay, not increase return. If you get better return, so be it, you're lucky. But the main reason for diversification is to reduce the risk in your portfolio. No one asset class can, bring down your portfolio value substantially. Second investment mantra that I would like all of you to adopt is successful planning is when the entire family is aligned to a purpose. Like I said in the very first slide, 20, like, and all of you agreed, we need to save about 20 to 30% per month, right? If that is going to be the savings rate, you need everyone in the household on the same page. Both the spouses have to have the same objective. Both the spouses have to be aligned to that objective of saving 25% per month. Okay. Both the spouses should appreciate, for the child, they are having a long-term plan. Okay. Suppose you have a girl child, you're putting money into an equity scheme. You're putting money into Sukanya Samriddhi scheme. You're putting money into a recurring deposit. So all of this gives the girl child a healthy capital when she grows up. And it is sacrosanct. No one is going to, disturb that investment until the child reaches adulthood. So when the entire family is aligned, you get the best results in your investment portfolio. That's it, friends. Thank you all for very patiently listening. I wish you all a very, very happy 2026. I hope you all adopt these investment mantras and, emerge as very, very disciplined investors who have a good investment worldview. I do wish that all of you continue to read up on investment, read a few investment classics, keep, track, the economy and, are aware of the risks that are there before every investment. If you have got a good advisor or a mutual fund distributor or an agent, very, very good. You can always take their help and assistance to help you chart out your investment and financial future. So we have, I think, around 10 to 15 minutes for, we have exactly 15 minutes for any Q&A. If you have any questions, please do post them in the Q&A box. I will try and answer some. Mr. Mittal, that's a good question. You said 2026 is very much similar to 2005, 15 and 25. How and on what basis parameters? Okay. The only basis and parameter in which I said was my mantras would be the same. That's all. Okay. On no other, you will, whether it was 2005, 2015 or 2025, you're better off saving 25% of your post-tax income. You're better off having a diversified portfolio. You're better off keeping your spouse informed of your investments. You're better off having a great investment worldview. Okay. So that's why it was different. Otherwise, definitely, yes, I agree. 2005, 2015 and 2025 were very, very different years. What is my outlook for 2026? It is going to be a good year for investing. I don't know whether you would get the results. It will always be a good year to save more. It will always be a good year to have a diversified portfolio. Please put some money into equities. Please continue to invest in, small savings and fixed income. Please continue to, put money into precious metals. That will give you a very, very diversified portfolio. We can add global investing into our financial planning. Is it good? Definitely, yes. The advantage in global investing is you get exposure to global stocks. You get exposure to a global currency also. So through the mutual fund route, you could invest in various global stocks. Okay. You could invest in various global markets. So when you invest in the mutual fund route, you're going to have a supervised and regulated investment. You would have SEBI, regulating it in India. The fund where it invests overseas would also be having a regulator in that country. And the advantage is you can invest in Indian rupees. The asset would be held in dollars. You can redeem and repatriate in Indian rupees again. So you would get both global asset class performance and global currency protection also. Crypto is fast emerging. Should it be considered as an asset class? In India, it is not an asset class of investing choice in India. Overseas, yes, it's an asset class, but I'm afraid not in India. It's not and in this forum, it's an unregulated asset. I would not be able to talk about it. How should an investor think differently about risk today compared to last decade? Essentially, the risks are the same, Mr. Srinivas. Okay, the level or the extent of the risk may change. That's all. Okay, but the same risk remain. You had interest rate risk 10 years back. You have interest rate risk now. Okay, you had volatility risk 10 years back in equity markets. You have volatility risk now. Okay, you have certain sectors that did very well 10 years back. You have certain sectors which are going to do well at this point in time. You had liquidity risk with physical assets that time. You have liquidity risk with physical assets this time also. But let me add, physical assets also have a financial equivalent. So if you want to invest in precious metals, you can invest through ETFs. You can invest through gold funds, silver funds, which are offered by mutual fund companies. Okay. If you want to invest in real estate, you can invest in REITs. Okay. You can either some mutual funds invest in REITs, or you can buy REITs that are listed in the stock market. Okay. So you can do this sort of thing where you can limit the liquidity risk in a physical asset. What is your view about AI bubble surrounding the market? I have no view on this because I have not studied, nor do I have competency in this. I have nothing in this. Sir, for 20% savings, first of all, Mr. Mehta, congratulations, you are having 20% savings, which is a very good saving rate. Okay. Like I showed in one of the slides, you can either invest in equities or you can invest in a mutual fund. You can invest in small savings investments. You can invest in debt mutual funds. You can invest in precious metals through the methods which I had recommended to you. Okay, so that way you are getting a diversified portfolio. In fact, mutual funds itself give you certain diversification in the sense you have a class called a multi-asset mutual fund. In a multi-asset mutual fund, you have some amount of money going into equities. You have some amount going into fixed income instruments, and you have some amount of money going into precious metals also. Okay. A multi-asset class mutual fund has to invest in 3 or more asset classes for it to be called a multi-asset, mutual fund. The big advantage in a multi-asset mutual fund is both liquidity, and in today's scenario, you also get a few tax advantages in that. I agree with you. One of you have said that savings rate goes up as you put years in service of work. So 20-25% at the initial stages will be very difficult, but picks up typically as you reach middle age and so on. I agree with you, but even in middle age, you have to be cautious about a few things. When you are middle age, your children would be putting a lot of pressure on expenses, and you might also have to take care of your parents. Okay, you and your spouse would have to take care of respective parents also. So that could be something that you need to factor in. So I agree there would be a higher savings rate, but there could also be higher expenses. You need to do the budgeting as a household. What is a common mistake you see long-term investors repeatedly make? I think the long-term investor has not made the first mistake of being short-term. That is the best thing that they have done, remaining long-term. But if you remain a long-term investor in only one asset class, then that is a mistake. Okay, you should diversify your asset classes, have a diversified portfolio with the risk assets, with liquid assets, with income-generating assets, etc. Then you have a diversified portfolio. But if you have the risk appetite for risky assets, then I leave it up to you. I cannot give any calls on market levels. It's not fair for me to do this. Okay, why some stocks appreciate unreasonably high in short duration without any positive development in favor of the particular company? Mr. Arvind Kumar, that is the market. Okay, like Benjamin Graham said, Mr. Buffett's mentor, Benjamin Graham said, the market in the short term is a voting machine, but in the long term, it is a weighing machine. true value and worth of the market comes over, a long period of time as the cycles change. In the short term, the market is nothing but a voting machine. That means each one is, buying, selling as per their, opinions, beliefs in the short run. Okay, there may be a wave to a particular stock, there may be a wave to a particular theme, there may be, fear of missing out or a herd mentality towards a particular sector. All of that impacts. There may be tremendous speculative activity or, F&O activity in certain stocks. So that could be the reason. There could be very small floating stock in that particular security. Okay, so or there could be illiquidity, so that the impact cost of buying or selling could be very high. Okay, or there could be genuine reasons also. I have no idea, but like just always remember Benjamin Graham's saying: in the short run, it's a voting machine. In the long run, it's a weighing machine. You need to be remaining in the long run so that the short run voting machine has got no impact on your long term real weight of your portfolio. That's what you need to look at. That's a good question. The last question I'm seeing: how many percentage can be increased annually in an SIP investment? That is called top up. Okay. So that is called a step up or a top up thing in an SIP. You must tell your investment advisor or the mutual fund house, okay, that you intend having an SIP which increases, every 6 months or every 1 year in contribution. It can either be a lump sum amount. So suppose you are charging you're starting say a 10,000 rupee SIP. You can increase it every year by 1,000 rupees, or you can increase it every year by say 10%. Okay. This is an excellent idea. Thanks for bringing it up. Okay. Have a discussion with your investment advisor, think about it and then see which, if your salary is increasing by 10% or, 10 to 15% a year, then definitely you should be increasing your contribution or stepping up your SIP also every, year by 10 to 15%. Or if your spouse is also, increasing, his or her earnings. Now, that also would mean that you can increase your SIP. Or if your savings rate is increasing, please increase your SIP contribution. So that is a slightly pain-free way, an automatic pain-free way of, increasing your investment capital. So good, very good. Thanks for bringing this up. I think that should be a good mantra for 2026. Stepping up the SIP, gradually over a long period of time. So you would be amazed. So when India celebrates its 100 years of independence in 2047, the good steps that you adopted in 2026 will have tremendous impact on the wealth that you have created, because you're getting 21 years of compounding, right? So if money were to, double, even if you're getting, say, 10% return, money would double every 7 years. So 10 lakh investment right now would become 20 lakhs in 7 years, become 40 lakhs in 14 years, and would become 80 lakhs at the 100th year of Indian independence. So 10 lakhs would become 100 lakhs. I hope, all of you, have a portfolio that gives you compounding like this. Okay. I cannot tell you how you would get it. You would not, I can only tell you one thing. You would not get a straight line return of 10%. Markets and the economy goes up and down. Okay. It goes up and down, up and down, up and down. But yes, the disciplined investor and the patient investor who are determined to be around in 2047 to redeem their investment or to make good their investment will be there to take the benefit of compounding and excellent returns. So thank you all once again. So I mean, there were many other questions. Okay, ETF monthly or SIP in mutual funds, both are good. Both, I mean, depends on your what do you say, comfort level. Okay, if you're doing an ETF, you need to have a demat account, right? Because ETF is done through the exchange. An SIP needs to be done through either a demat account, or an SIP can be done through the mutual fund house or through a distributor. Okay. So that's it. Thank you all very, very much. It is a pleasure making this presentation to all of you. Once again, my best wishes to each and every participant in this seminar for a wonderful 2026. I hope this session was very useful to all of you. I enjoyed bringing it to all of you, and my sincere thanks to the team at NISM for enabling this program. Thank you again, and over to you, Sahil. Thank you very much.
Yeah, thank you so much, sir.
Thank
Would
you.
like to extend our heartfelt thanks for taking time and speaking at our webinar. Your insights, expertise, and presentation as well, which was fully of knowledge and information. Yeah, thank you so much, sir, again for sharing your time and knowledge with us. Yeah, wishing you a
Thank you.
wonderful day ahead.
Thank you. Thank you. Thank
Thank
you.
you so much. And also thank you to participants as well for joining us today and coming in huge numbers. Yeah, thank you all for joining for today's webinar. Thank
Thank
you.
you.